Alright everybody, we're gonna have a little bit more of a serious discussion today. So I need you to sit down, strap on, and we're gonna get to it. I'm not editing that. When you see risky, volatile assets, how does that make you feel inside? Does the thought of making money really excite you? Or does the thought of losing your money really scare you? These two differing views on risk are going to determine how you navigate through any marketplace, be it stocks, bonds, cryptos, and of course, video games. And this conversation today is going to be more directed to the people who are new to the world of finance and investing. Looking at my analytics on the YouTube channel here, 50% of you are between the age of 18 and 35. So there are a lot of people here who probably don't have experience with investing, be it traditional or just speculating. And I think this conversation will provide a lot of things to think about for people who are looking to join into the financial or speculating side of things. So I'm sure for some of you, video games are the only thing that you purchase that could even be considered an investable asset at this time. Or maybe you're someone who's looking to begin taking the hobby more seriously and try to look at it from a more financial investing perspective. Many people will ask me, how do I get started with this? How do I begin learning this market? And I'm here today to tell you that the biggest tool you will ever have to learning any kind of financial market at all is going to be exposure. Exposure of your capital. When you see someone who makes a substantial amount through investing, or you see someone who loses a substantial amount through investing, the common principle between these people is market exposure. And if you want to begin taking this more seriously and making real decisions in the market, you're going to have some skin in the game. Consider this. Have you ever been playing poker with your friends where there's no actual money on the line? Did you play differently than you might otherwise? What about with stocks, if you've ever done any kind of trading? Have you ever worked on the practice portfolio where they give you fake money and you're allowed to just simulate real trades? Did you buy and sell positions differently than you otherwise might have? When the money or risk isn't real, or we don't have a vested interest in the actual outcome of the events, we may do or say things that vastly differ from what we would actually do when put in the real scenario. These simulations of real events become exactly that. They become simulations where you don't have to consider the actual consequences or outcomes of your decisions or actions. Under these false assumptions that are devoid of actual risk, you become far less emotional of the outcome than you otherwise would be if there was risk involved. Because it's all for fun anyways, right? So it doesn't really matter. But once you add the exposure, the risk, and you put some skin in the game, you immediately learn about the emotional weight of spending your money, risking your money, with absolutely no guarantees and the possibility of losing a large portion of it. You now have to accept the actual risks associated with your decision making. You can't just disregard the notion of being wrong. All of a sudden, if you're wrong, there's a very serious consequence involved, and that consequence could be substantial loss of capital. And if you've never done anything like this before in your life, where you have to deal with the emotional weight of your decisions in such a way, it can be a deep learning process for you where you're going to learn very quickly what you're actually like and the personality traits associated with it. Put very simply, talk is cheap. We've all heard the saying before, right? Talk is cheap. Even for me, sitting here, talking about video games to you guys. Let's say I didn't own any video games, or maybe I only own a very small portion, right? I don't really have that much exposure to the market. You wouldn't take me as seriously because you'd be under the notion of, well, this guy doesn't even practice what he preaches. Who's this guy to tell me about the video game market? Naturally, we assume that someone who is invested will both talk and act differently than someone who isn't. You're not going to go ask for crypto advice from the dude who has never bought before or from the guy who doesn't hold any. And that's why I'm sitting here telling you today that your actions and your views of everything will change once you actually get exposed and enter into the market. But the fun part is that you won't actually know how these changes will take effect on you until you actually do it. When someone asks me about price checks or if this is a good buy or what should I buy, all I have to say is go ahead and buy something. Don't worry too much about slightly overpaying or slightly underpaying or buying the perfect item. If you are new to this and you're just getting started, just go out there and buy something. Once you've done it and you have it in your possession, think about how you feel about it. Do you all of a sudden feel like an idiot for spending hundreds, if not thousands, on a video game? Because there are some people who are going to feel that way. Especially the moment this bull run ends, everyone's emotional weight about this is going to change. I truly feel for many people in this amazing bull market, in any bull market, it's just fun to jump in. It's just sexy to be a part of it. It feels like a sure thing that you're going to make money. It feels like owning expensive video games is going to make you so happy because you see all these other people around you they're making money, they're buying video games. We're all laughing and having a great time, right? All of that emotion and perception can be wiped away in an instant if the market takes a turn. For many people, when these crypto bull runs take place, or when GameStop starts exploding, or when video games start exploding, They just sit on the sideline and do nothing. They will simply watch and observe everything taking place around them. During the massive bull runs, they may feel this intense fear of missing out, or maybe they don't even know how to enter, or maybe they'll just always tell you about, oh, I could have gotten in at this price, but I didn't. And then during the crashes, they're going to commend their intelligence because they knew it would all crash and they never got into it because all that stuff is just junk. And it's possible that some people like this do other safer investing and that they truly do just sit back and watch markets like this because they want nothing to do with this type of volatility. Much like graded games, there are people who collect video games who will never enter this market because they just want nothing to do with this level of risk and volatility. And I mean, really, this level of volatility has been across almost all collecting categories throughout 2020 and a little bit into 2021. We all saw how fast Pokemon went up and then how fast it also came down. We all need to be honest and accept that that risk does exist. And then you have to be honest with yourself. Can you accept risking your capital in a market like this? Because that's what it is. It's a risk. But the truth of the matter is that at some point we are going to see a downturn in this market. Every market will experience a correction at some point after exponential gain. It is inevitable. Nothing goes up in a straight line like this forever. And the downturn could be quicker than anyone anticipates. Or it could be another 5 years from now. We don't know. But with that said, if you want the potential to make any kind of money in any kind of market, you have to expose yourself to the risk. So let's say you take that step. You join in and you start participating in a collectibles market with stocks, with crypto. You take that next step and you start to get some skin in the game. Once you do that, you're immediately going to learn about what type of investor speculator you really are. And there's really two pivotal different types of mentalities that take place in this. You're either trying to maximize your potential upside or you're trying to minimize your potential downside. When you look at something speculative or looking to invest in something, do you ask yourself, how much can I make off this? Or do you consider to yourself, how much more could this potentially go down? Are you strongly considering upside or are you strongly considering downside? And neither of these two methods are wrong. People are going to be successful with both trains of thought. But what you need to do is consider this type of thinking when you do go to make your purchases in any kind of market. And let's actually just talk a bit here about how you would actually maximize your potential upside in a market like video games. Because really, it's easy to do this when you're not considering any kind of downside risk. What most people will do in this type of scenario is go out and buy 5, 10, 50 copies of the exact same game. Why would you do that, right? Why do I want 50 copies? Because if you hit big. And of course, the exact same thing exists on the other side. If you miss big. But if you target very specific few things, you have far better chance of amplifying your gains than you would if you were diversified a whole bunch of them. Now, even if you take this kind of path with video games or collectibles, you know that the floor on these items is not zero. There is always going to be an inherent floor on these items. Say you buy an item for $100, there's no world where it just goes to zero. Even if it just goes down to $25, $50, right? You might lose 50%, 75%, but unlike stocks or crypto, you can't go bankrupt with video games. You'll always have some value there remaining. So I mean, hey, that's enough reason in itself to start investing in video games, right? But another issue with this potential upside strategy is that even if you buy a whole bunch of a single collectible, and those just kind of stagnate, or they only go up maybe 10% or 20%, the price just doesn't really move on them. Well, now you're still eating a very big loss with the opportunity cost of what that capital could be doing. When you're only holding a single item, you're stuck in the spot where, well, it either goes up or it doesn't. It's not like, oh, well, 5 of my games went up, 3 of them stayed still, and 2 of them actually went down, but overall, I'm doing pretty well. It's not like that anymore. What I will say, though, is that, yes, I get it. Most people entering into the market aren't going to enter in with this kind of mentality. This is far more akin to stocks or crypto, where you see people just YOLO all their money on a GameStop stock. Not a lot of people have the experience or capital to do it with physical assets. But still, you should be aware of this type of strategy and aware of the type of risk tolerance something like this would take. There will be a time in your life where you can go all in on something like Bitcoin or GameStop or maybe video games. And you should know if you can actually tolerate doing something like that or not. For most people who enter into collectibles, though, it is going to be this very diversification approach where you buy a few things over here, you buy a few things you like over there, and by nature, you will be diversified and you will have more limited downside. So that is nice. And if you want to call the maximizing upside your momentum investing, this side would be way more of your value investing. You're looking for things that might be being sold at value so that you limit the potential downside that that item might have. Instead of paying record prices for something, you're looking to find something a little bit already below the market value, or something that you think isn't already being appreciated as much as it should be. You're not chasing after the momentum of the market where everything is doubling, tripling overnight. You're looking over here for potential value. And this is actually how I've done most of my investing and collecting over the years. I am a value investor through and through. I always consider potential downside way before I consider potential upside. I almost never buy multiple of the same game unless I can get them at a truly low price. And I almost never overexpose myself on a single item. Now, of course, right, I say this, in 2019 when video games started to explode, I missed out. I missed out on a lot of potential returns and gains. And why, right? Why did I miss out on so much free money? And that's because I didn't want to be caught FOMOing into a market that was all of a sudden doubling and tripling. I didn't want to expose myself to that kind of risk where it felt like the prices that just doubled or tripled could also just cut in half in the next month. There was absolutely no price history to justify any of these movements, and there was absolutely no guarantee that this whole video game collecting, investing, speculating thing was going to be a thing. So even while everything around me was going up with momentum and prices were doubling and people were diving in with a lot of money, I still only tried to target value rather than buying all the things that did end up being the true winners of the market. But those are all unknown variables that we don't know at the time, and I wasn't willing to take on that level of risk. The guy who sold the Mario 64 for 1.56 million in 2019 and 2020, he was willing to take that risk. And you can see that by taking a strategy where you were buying the momentum or looking for the potential upside, in this instance, yeah, it worked out very, very well. But that does not at all mean it will continue to work or that it will work again in the future. You really have to be honest with yourself about how much risk you want to put forward. Yes, it can work out very, very, very well, or it can work out terribly. So what I want to say at this point is that before you dive in and you start buying graded video games or other highly speculative items, collectibles, you should really write out a budget for yourself and a bit of a plan as to what you hope to achieve. Maybe make yourself a budget, make yourself some items that you do want to try and track down, and maybe some prices you do want to try and pay for them, and then actually try to stick to the plan. If you write down that you're going to sell when an item hits a certain point, you actually have to sell it then. When you're actually participating in the market, both buying and selling at the same time, this is when you're going to shield yourself the most from maximum downside. You're going to be taking some profits over here while still speculating over here. It truly is the best of both worlds. When you're new to everything, I don't expect you to be able to do something like that. But as you continue to grow and continue in the market, you should really consider what of your items you might be able to sell in order to take advantage of some of these high prices as you're also buying. Just so you can incorporate a little bit of hedging into your actions. Of course, most people are just going to jump in recklessly, and hey, I get it. In 2017, I sold about $10,000 worth of video games, and I threw it all into XRP. XRP is a cryptocurrency if you don't know. A lot of people still call it Ripple, XRP, cryptocurrency. I threw in $10,000 2017. And you know what? I got lucky. I bought when it was actually at a low. Imagine if you had bought Bitcoin in 2017, in December or January, right when it was around $20,000. And then in the next 3 years, you watch your initial $20,000 Bitcoin fall down to about $3,000. And you're gonna say, yeah, sure, but if you had just held, right now it's worth $45,000, so who cares? And I'm going to tell you that the amount of people who actually held from 2017 highs all the way through the lows, all the way back to the 2021 highs are extremely few. Because I'm going to tell you, if you've never experienced loss where each day you wake up and you're losing another 7% of your investment, you know what you do at that point? You cut your losses. The emotional weight and stress of constantly being reminded by your portfolio that, oh, today we lost another 13%. Oh, hey, you're down another $400 today. That takes an extreme toll on people. Now with video games, you're fortunate because we don't get daily updates like this. You're only going to learn in 3 to 6 months to a year later that you really fucked up. And if that happens to you, do you have the emotional intelligence? Can you deal with the weight of a decision if you have to cut your losses on something? What if you run into a situation where you have to sell at a loss? You literally need the money back. Have you ever had to deal with something like that before? Can you deal with that kind of decision making? Because I can almost guarantee you that if you continue to stay in speculative markets like video games, now graded VHS is becoming very popular, maybe you're chasing after those, maybe you do cryptocurrency. If you participate in these markets, you will find yourself in a position at some point with substantial loss on an item. And at that point, you have to be honest with yourself about what you're going to do. And hopefully when the time comes, you can make that decision. I thank all of you for hanging out for today's TED Talk. Hopefully you'll learn something about this. Hopefully this talk gives you something to think about. If you enjoyed this kind of video, if you're still watching at this point, make sure to hit the like button, leave a comment down below. I will read it and I will respond to you. I'm curious to hear your thoughts on everything I said today. I personally love talking about these kind of financial theory perception type videos. So hey, you're gonna get more of them in the future whether you want them or not. And hey, I'll see you guys next time.